Hello, this is Arthur Hill with StockCharts.com. You are tuned into a video edition of the Mailbag. Today we're going to show you how you can reduce volatility using three classic Japanese charting techniques. So I'm going to start off with the Nasdaq-100 Etf, and this is a line chart. And you can see here that it does have a few zigs and zags as it moves down. And then you had an advance and it kind of chopped around in August, another advance, but you can see every little move on this chart. And if you want to filter out some of these smaller moves and focus only on the bigger moves, then you can apply one of these three Japanese charting styles. And the way you find those is you scroll down below the chart and you will find the chart attributes section. And below that you will find chart type. And we currently have solid line, but if I click on that and you scroll down to the bottom, you're going to see three possibilities. You can do the three-line break, the Kagi, or the Renko charts. And we're going to start off with the Renko. So once you have chosen Renko as your chart style, you're going to be given some other options. We're going to choose a box size, and it can be based on the average true range or points. And we're going to choose points. And it's set at 1 for the default, but I'm going to go ahead and make that half a point because the QQQs are priced under 100. And you can choose the high-low range or the close, and I'm going to stick to close to keep the volatility low. So you click update and you will get a new chart. And you can see that a lot of the little squiggly lines have been removed. And now we have a smoother and less noisy chart. For example, you can see that we have the decline in June. And then look at the long advance in July. No squiggly ups and downs, just one straight advance because the noise has been filtered out. And also notice that the time scale is not uniform at the bottom. And that's because time only evolves when you have price changes. If price stays the same, then time stays the same. And then when you get a significant price move, then you will get the x-axis changing or the time scale changing. All right, now let's look at the Kaga charts. Again, we're going to scroll down to the chart attributes section, and chart type, we're going to change from Renko to Kagi. And we're given another set of options. You can base the reversal on percent, points, or ATR. And I'm going to leave it at percent. We can fill in that field. I'm going to leave it at 0.5%. And we can choose the high-low range or the close, and I'm going to leave it at the close. And we click update, and we will see a Kaga chart. And again, you can see that a lot of the noise is filtered out. And what's also nice about these charts, look how easy it is to spot support and resistance levels and even to identify patterns. You had a lot of resistance here around 74. Then you had resistance at 77 that was broken. And then you had resistance just below 80 that was broken. The next recording style we're going to look at is three-line break. And of course, that can be found under the chart type. And it's right above Kagi, and you choose three-line break. There aren't any settings available for this. And click update, and you will be shown a chart based on the three-line break. And it shows a little bit more detail than the other two. So on this, you can see the white lines represent rising prices, and the black or the red lines represent falling prices. And prices continue in the same direction until a reversal is warranted. And a reversal occurs when the closing price exceeds the higher low of the prior two lines. So you can see here we went red, and then we had this move above the high of the prior two lines, and that was the reversal. So I hope you've enjoyed this little video on how to use these three Japanese charting methods. You can read more about these three methods in our chart school, of course. And also there is Steve Nissan's book, Beyond Candlesticks. Thanks very much for tuning in and have a great day.